Welcome to Business Talk here on businesstech.co.za. Now, entrepreneurs will spend decades building a business, but surprisingly, very little time planning how they will eventually exit or leave that business. And it can be a very expensive mistake because the headline sale price is not necessarily the amount that ultimately lands in your bank account. The way the transaction is structured, the timing of the sale, the tax consequences, and even decisions taken years before a buyer arrives can all materially affect the value that a business owner ultimately retains. And I have this joke often in private equity that, someone works in private equity because when they enter a room, they're the first ones looking for the exit. And I say it in jest, but it's because that's where smart money understands where real business value is made. You plan for the exit many years in advance. So to unpack how business owners should prepare for one of the biggest financial events of their lives, I'm joined by Stanley Broun, Head of Fiduciary and Tax at Sanlam Private Wealth. Stanley, great to have you on the platform. Entrepreneurs, as I say, spend years being told never to give up. So maybe let's start with the psychologically difficult question. How do you know when selling the business is actually the smart decision?
Good day, Michael. Thank you so much for the opportunity. So it is a psychological, one of the big aspects is psychological, because in principle, what entrepreneurs has done is they've actually inserted a lot of amount of the time, the expertise in order to get the business to where it is. So in principle, what they're looking at is to say, when my business reaches a certain stage, at that specific stage, it will then be clear to me that this is the correct stage to actually start looking at selling my business. And typically in my engagement with those type of clients, they typically say that my business is now on a trajectory, it is growing, it is expanding, and now it's an excellent time to look at, is it possibly a good time for me to sell the business?
I guess it's difficult because every entrepreneur is different, every business is different. But generally, when you chat to entrepreneur founders, is it primarily about things like valuation and market timing, where you just see that exit window opening, or are there better signals, sometimes more personal, things like succession? Maybe you've grown a business, you don't really see the children taking over. Maybe you just fatigued, or you just simply recognize that the next phase of growth will require maybe a completely different ownership or management set that you don't feel you have as a builder.
Michael, you're 100% correct. It's a combination of different elements. So for different clients, it will mean something different. For some entrepreneurs, it is that window opportunity where it is the ideal time to sell the business. That will be some of those type of entrepreneurs. Your family-owned businesses will be that we've really built this business and we're ready to step out of the business and hand it over to someone that could actually now continue to grow it and expand it. And for some, it is to say that I've now built this legacy, I've done my part, and then to sell the business and to look at new opportunities where they can invest in something different, building another business, or they might have an alternative business they already started to build, and they say it's good to exit business one, now we can actually focus on business number two. So it's entrepreneur, family dependent, but all of these aspects actually plays a role, and it's unique to each specific entrepreneur or family group. Yeah.
I would imagine, though, and this is my suspicion, that many owners really only start thinking seriously about the structure of a sale when a buyer has already arrived. By then, how much of the chessboard is already fixed? And ideally, how far in advance should an owner begin planning for a possible exit?
So let's start with how you ended it. Planning is key and important. If there's any inclination or intention that you would like to sell the business in future, it is good to start as early as possible to make sure that your business is always ready, and we typically call it business ready. Are your business ready for sale? So what will happen is, if you do wait too late, then when you go through negotiations and you want to start making changes, it impacts the deal and the momentum of the deal taking place. So I typically encourage clients, and based on my experience with engaging with entrepreneurs selling the business, sometimes they come too late and there's very little that you can do to assist them to properly structure the business, especially from a tax efficiency point of view. In other elements, we get clients that says, we're looking at this, a deal came across our table, we might be interested, or we're looking at saying in the next 5 to 10 years or 2 or 3 years, we'd like to sell or step out of the business. And that is the ideal time to say, fine, are we business ready for a sale? And then to make sure that we put actually all of the structures and the processes and the paperwork in place to prepare the business for sale. So when the opportunity does arrive, you are structured appropriately, you know how you're going to enter the deal, you know what you're selling, you know what you're putting on the table. So all of those elements are key and critical. So the key part to it is planning, but planning in advance for that possible sale.
Yeah, because the last thing you want to happen is going into a due diligence process where you've got a potential buyer and then something comes up that you didn't anticipate or see in the DD, and that destroys a lot of value in the process. So let's say an owner comes to Sanlam Private Wealth and says, right, I may sell my business in the next few years. What is the first diagnostic or suite of diagnostics that you run?
So from our perspective as Sanlam Private Wealth, when we step in, the first aspect that we look at is understanding the client, the individual, the family who has actually built the business. It's important for you to know who's the family, who sits behind it, who are the people that has worked to build the specific business. You want to know who are the people leading in terms of who's the CEO, who are the directors, who's the CFO, etc., and how that actually is structured within the business, especially in the family group business, because most family members are typically involved in certain aspects of the business. Once you have that understanding and you understand the family, then we start looking at the business structure. They take us through the business structure, how they've started to build the business, what the structure look like currently. Based on that type of analysis, we will be able to go back and then to see if this client should then now go forward in selling the business. Is the structure the right structure for the sale, for what they anticipate to do in the near to medium future in the sale of that specific business. So we come in, and instead of just looking at the business structure, is to understand the family that sits behind the business. And once you know the family and you know their values, what they want to create, it gives you an opportunity to then understand the structure much better, because behind the structure are always individuals who has built the business. So to your first point, that psychological and that emotional connection sits there. And in order for you to connect it and to say, fine, this is how we can move forward to prepare the business for sale, you take all of those softer elements, if I can put it that way, also into account, because you're actually selling a part of who you are as a family, which you've worked for. And sometimes we miss that human element. So from a Sanlam Private Wealth, for us, the client is key. How we focus on the client, the family is key. Then from there, understanding the business and knowing what the family wants to achieve at the end. Yeah.
Yeah, and I think it's so important to marry those two. Of course, they're the hard elements, or so-called hard elements, of understanding where the assets sit and who owns the shares and the structures and the tax and all of that. But understanding the psychology, how has this been built into the estate structures? Who gets what in terms of family, and often the family scattered all over the world in South Africa today. So all of those, I think, almost matter more when it comes to something that has been a baby that you've raised from the very beginning as an owner founder. And I think often advisory firms kind of miss that as well. Talk to me about the sale price, because I mean, as I said in my introduction, it's not the amount that you keep. And I think we focus in the financial media on the headlines. We tend to focus on the transaction value. I think the seller should presumably be far more interested in the kind of after tax, after cost proceeds. Where does value most commonly
100%.
leak out of a deal?
Yes, the question will always be, as I tell my clients when I do meet with them, is to say, what do you want to walk away with at the end of the transaction? So on paper, it looks good. The headlines looks fantastic. But when you take all of the costs into account, especially the taxes as well, what you actually walk away with, and it's basically to understand that from the client. And then to say, now that we understand what you want to walk away from, that gets built into your price as well. But in terms of that, then we start looking at, is the structure optimally structured in order to make sure that when the deal takes place, it takes place in a more tax efficient way. And where we do restructuring of the business, then is to say, does it fall within the ambit of the legislation, making sure it does, and then in doing so, making sure that we actually prep the business in the proper way for sale. So when you actually go to the negotiation table to say, this is what we want to achieve, you know what you want to walk away with, you've done your homework. And I think one of the key things, Michael, that I normally tell clients when I meet them initially is that always make sure that when you start the process and of thinking about it, surround yourself with the right experts. Surround yourself with a team of people that will be able to provide you the correct advice in structuring, making sure that they can actually get you the proper deal on the table, assist you in getting business ready for that specific sale to take place. So those are the type of elements that is quite key and important. And I do know cost is a big thing for the client, but to go in solo can actually cause more harm than good at the end of the day. So get your team of experts together. They will advise you, they will support you through the process, and they understand the market sometimes, and they know what is happening within the market, and some of them can actually find you to get a better deal or the best deal that actually speaks to what you want to achieve at the end. Yeah.
Yeah, and I think it's important because I think two transactions with exactly the same headline value could leave their sellers with materially different amounts of wealth. And I think so often the owner is focused so heavily on the headline price, they miss the economic substance of the deal as well. I'm sure you've advised on many transactions. What do you tend to see as the big mistakes that that sellers make when it comes time to realize value from their primary asset that they've been building through their lives?
So one of the big mistakes that I typically encounter with those type of entrepreneurs is that they've entered into a deal without understanding the tax consequences of going into that specific deal. So, Michael, from a commercial point of view, the contract is set up perfectly fine. But within the substance of that commercial contract, you haven't embedded the relevant tax elements that will actually feed into a more tax efficient sale taking place at the end of the day. So what I do see happens is that client signs a deal, and when the deal is signed, it's done. And when we look at the deal, then we say, but this is your tax consequences. And that was never the intention of the client. And therefore, it is important before you step into that negotiation room in order to say, this is what I want to sell the business for, is then to ensure in principle that you actually pull in your commercial attorney to help you to set it up commercially, but also pull in your tax expert and tell the tax expert, this is what I want to achieve. Is this commercial contract actually going to result in that as well? And the two can actually live within the same ecosystem to actually get the best result for the seller.
Yeah, and increasingly, I think, sellers don't simply receive a check and walk away. There may be earnouts, there may be deferred payments, retained equity, and all of those create renewed risks. But I want to move to what happens then afterwards. You've been building this business your whole life. And I think often we underestimate this. And I talk a lot about, retirement and retiring to something. I think it's very similar for an entrepreneur. You've been building a business. Now you own a very large portfolio of cash and maybe a couple of investments. Why is that transition harder than it sounds? And how should families think about making that transition and ensuring they invest that cash that they've now gained from the exit of their business wisely for themselves and maybe future generations?
Yes. So it matters to what you've spoken about before, the psychology behind the sale of the business. When I sit with the client, I typically ask the family, what does life look like post the sale of this business? Because if we can understand from the start of the process what life looks like post the sale of the business, that all can form part of your structuring in the way you're going to sell basically the business. Do you sell it in a trust company structure? Do you sell it in your individual name? Where are the children located that will also benefit from the sale of this business? Are some of them in South Africa? Are some of them living abroad? Are they still beneficiaries of the trust, but they have ceased their tax residency? So all of those elements play a role. But the planning to it, Michael, is key. So what we do at Sanlam Private Wealth is when we start engaging with the client, we understand the family. That's the foundation, because we want to make sure that we marry the family values in terms of how they've set up the business. But through the process, and this is why it's important to have the team of people from the start, is then to guide them to say, if this is the outcome that you want from the sale, but this is the outcome post the sale, life after the sale of the business. And typically, to your point, that is their retirement, is then to say, how do we package everything at the beginning so that there is an ease of transfer from the sale of the business into retirement? Because typically what will happen quite a few times is you sell the business and the person just sits with cash in the bank, but there's no plan. So what we typically do from a Sanlam Private Wealth point of view is we basically go through the process with the client, and as we structure the business deal, we also structure that retirement planning for the client, which is very key, which is very important, because a shift from going to run a business to the shift of going into retirement is a major shift. And what we want to do is to make sure that we support the client, guide the client, make sure everything is structured properly, but also have a plan to say, this is your plan post the sale of the business, this is your retirement plan, and this is how we can actually support you. And that is where we pull in the portfolio manager, we pull in the wealth manager to start looking at it for the client. So when the funds does come into the bank, we know what to do with the funds, we know how to invest it for the client, and we know what the objectives of the client is post the sale of the business.
Yeah, it's so, and listening to you talk, it's so much more than just an investment question. It's family governance. It's, having a letter of wishes, maybe estate planning, all of those things, and deciding, how much of that wealth is going to be for my own lifestyle as a founder, what must generate long-term income, what do I pass to the next generation, how do I involve the kids and heirs without creating entitlement? And, we've seen very high-profile examples of very wealthy investors grapple with this as well. So these are not easy questions to answer, but I think it demonstrates that you need an advisor or someone who's walked that path many, many times before going and paying your own school fees, so to speak. Stanley, just for the concluding kind of thought here, if you're a business owner and you're listening to us today and you think a sale may be 3 or 5 years away, what's the single most valuable thing that I should do today?
The first step I will take, and what I will advise that individual be, is reach out to experts to get a full understanding of how it works. Reach out to your experts so that they can assist you to look at your current structure and support you in the preparation. Reach out to your experts so that you can start your estate planning upfront. Reach out to your experts, because at the end of the day, this is all integrated. The sale of the business, looking at the family, looking at wealth preservation, looking at intergenerational wealth, also looking at the psychology, addressing issues along the way, and making sure that everything actually fits in like a puzzle. So when you get to the end of the process, that puzzle is complete and everything just falls into place. So my single best advice I normally give to entrepreneurs is, when you've got the thinking of wanting to sell your business, surround you with the proper team of experts. That is what we do at Sanlam Private Wealth. Then we support the client through the process, pulling in the different type of expertise so that the client knows that I can go, continue to build the business, and once I am ready, my team of experts has already structured everything and they will support me through the process.
I love that puzzle analogy. I love building puzzles and 1,000-piece puzzles. What do you do first? You go and you get all the straight edges out and you see if you can get a border, and then you fill it in from there. And more often than not, you have an enjoyable experience. If you're still looking for filling in the border pieces right at the end, that's when a puzzle turns into a bit of a nightmare. So Stanley Broun, thank you very much. Head of Fiduciary and Tax at Sanlam Private Wealth. I think the advisors are the edges. You need to go and sit down with the advisors before you build in that puzzle that you want. And the time to start planning the sale of a business is certainly not when the buyer sends the term sheets. I think the best exit planning begins while there's still a lot of time to make those deliberate choices. So thanks so much for sharing those insights with us here on Business Talk. Take care.
Thank you so much, Michael.